Okay, this video covers futures options. It's material covered at the end of Chapter 8 of our textbook. And here's what I want to cover in this video. And by the way, as I've said before, this material shows up as extra credit questions if if it does show up at all on quizzes or an exam. Because I understand there's a lot of material in futures contracts to begin with in Chapter 8, and then covering futures options is just, it's a bit much, it's more complicated. But it's almost straight up applications of what we've done before with options contracts. So options on futures are, they're out there, they're traded on the Chicago Mercantile Exchange or and the CBOE, the Chicago Board of Options Exchange. So, and these concepts here show up on the CFA exam, Chartered Financial Analyst exam. So it's important that I at least cover it if you're interested. So what I'll do is I'll cover the background, including the opportunity cost. There's a few quirks associated with futures options. I'll talk about lower bounds and intrinsic value. And again, those quirks will show up. We'll do the binomial option pricing model briefly. We'll do the black model, which is a spin on the Black-Scholes-Merton model. So Black-Scholes and Merton developed the model we studied earlier, which is the workhorse of options models. Fisher-Black, who is the Black of Black-Scholes-Merton, he developed shortly after the Black-Scholes model came out, he developed a model that dealt with futures options and also currencies, foreign currency options, and it's called the black model. And that black model takes into consideration the little quirk in the opportunity costs associated with futures options. Then we'll look at futures put call parity, and we'll see again some of that quirkiness around opportunity cost will show up there. And we'll discuss briefly early exercise, and it actually may be optimal to exercise futures options early, call options early, which is slightly different from what we studied earlier with regular stock options. So before we get started in the actual analysis, let's make sure we know what a futures option can do for you. When you are long a call, futures options call, what it does is it allows you, that call option allows you to exercise into a futures contract, long a futures contract. So when you have a call, a futures call, it allows you to go long into the futures contract. You're not obligated to do that. You have the right to do that because you have the optionality on it. Okay? But once you flip into the futures contract, then you're obligated to fulfill the futures contract, and the option kind of goes away, and you're left with a futures contract. Long a futures contract. Now, if you have a put in a futures option, then you have the right but not the obligation to enter into a short position in the futures contract. Again, once you exercise, the option goes away, and you're left with a futures contract that then obligates you, in this case with a put, to sell the futures basically. And so keep that in mind. I'll repeat it several times throughout this video. So the first thing I want to do is let's get a timeline to see why options on futures are a little different. And we start off with the normal time zero, and here's expiration. And what we're going to do here is we're going to assume that the option contract on the futures, so let's make sure we're clear here. A futures option means that you have the ability, you hold an option, a call option for example, that allows you to, quote, buy a futures contract, meaning enter into a futures contract long. And a put will allow you to enter into, to sell a futures contract. Now the point is, you enter into these contracts, if it's an American option, you can exercise at any point, right? Any point up until expiration. And so if you exercise early an American futures option, call for example, you're going to flip into the futures contract right here. But for example, that when you flip into, when you get or enter into a futures contract, you don't have to pay anything. Remember, you enter into the contract, and that's why I say in quotes here, buy. You enter into it, you don't have to pay any money. So in that sense, there's no opportunity cost associated with that. Now, you could take that American option and not exercise it until right at this point, in which case it's the European and the American options are the same thing. But right when you're at this point, you have to consider the fact that, okay, since the option and the futures contract mature at the same time, and that's the assumption we're making for simplicity, then you have an option that flips into a futures contract, and that futures contract is maturing at the same time, so it flips into the underlying. And so when you're going to eventually have to pay the underlying, because when you enter into a futures contract, you're obligated. So no matter when you're along here and you exercise your option, you get a futures contract. You're forced, remember, you're obligated to fulfill that contract, and you'll fulfill that contract at time capital T here. Okay? So if you flip in early into the futures contract, your futures contract is going to reflect the fact that in the future you're going to receive or pay the futures price, and there's going to be a strike associated with it. So there will be some discounting associated with that. So there's some opportunity cost associated from here to here. But the fact that you're flipping into a futures contract that doesn't require any actual cost, because it's not like some asset where you have to pay for it right away. You're entering into a futures contract, which means all the payments happen at this point. So that's the bit of the quirkiness behind the concepts of futures options. Now, let's go into the lower bounds, and I'll cut right to the chase on the lower bounds. There are American call lower bounds, and the way we write that out is it's the futures price. So this takes the place of S that we're used to seeing, and so now we're looking at the futures price. We're looking at time to maturity in X. So those are the three main variables that are associated with valuing this American call, and the intrinsic value is going to be in other words, this is basically a lower bound. You see that greater than or equal sign? It's telling us it's a lower bound. It's the maximum of 0 or comma, I'll write it down here. Okay, it's the maximum of 0 or the difference between the futures price and the strike price. Okay, and so this difference is on a per unit basis of the underlying. So it's on a per share basis, for example, for a stock or a stock index, or it's per bushel if it's wheat or corn, for example. So when you want to scale it up to a contract size, the futures options contract size, they inherit the futures contract size. So we multiply this by the futures contract size, because when you have a futures options contract, you're flipping into the futures contract. And a futures contract for corn, for example, is 5,000 bushels. For a stock index, it could be a multiplier of 250, and you'd have to look that up because every index is slightly different. Okay, so that's an American. Notice there's no discounting associated with this. By the way, that's a multiplication. That's a times. That's not a strike. Now, for a European call, oops, get rid of that. The lower bound, it's basically an intrinsic value, but like I said before, your textbook authors are really picky and splitting hairs. That they believe that intrinsic value means it's the value you can get your hands on immediately if you exercise an option. But most people look at the difference, for example, between the futures and X here as being the intrinsic value. But with the European, remember here, that you can't exercise it until time T. So therefore, it's the maximum of 0 or F, the futures price minus the strike, all divided by, make sure it's clear, all divided by RT to the T power. Now this looks slightly different, and that's again the quirk I'm showing you with the opportunity cost. And I'll show you, we'll prove this by doing put-call parity for futures. Futures, options, put-call parity. And what I'm saying is different is we're used to seeing the, for stock and stock indexes, we're used to seeing this lower bound is looking like this. Okay, all we did was we discounted the strike back because, okay, we're going to eventually pay the strike at expiration, but what's the present value of it? Well, that's it. Well, what's the present value of a stock price today? It's the stock price. So the present value of the stock is the stock price. But with a futures contract, you're going to lock in, and you're going to, when you have a call, you're going to receive this value. What is the present value of this? Well, it adjusts and does take into consideration the present value here. So it's the present value of the difference between the futures price and the strike. Slightly different than what you saw earlier when we covered boundary conditions in chapter 3. Again, I'll show you this difference here will show up when we do futures, options, put-call parity. Okay, so I have an example in the notes, and it talks about, suppose it's a June 7th, and an investor holds one futures contract in July wheat futures, and we obviously recall that the futures contracts are 5,000 bushels per contract. The strike is $6 per bushel. The current price of wheat for July delivery, which July, by the way, is 40 days from now for the expiration, as I'll tell you in a minute. The current price is $6.08. The option, therefore, is in the money by 8 cents. And so for a call, the value of the call simply is the greater of the maximum of 0 versus 6.08 minus the $6 per bushel. See, this is on a per bushel basis, times the contract size, which is 5,000. Now, in this case, the options are in the money, so this part kind of goes away. And really, the value, the lower bound is this. And that equals $400, okay, for the lower bound of this option. So for the European now, where there can be a delay in the exercise, well, there has to be a delay in the exercise, then we have to discount both of these things back. And so what we're going to take is, so the easiest way to do that is, look, take the 400 and divide it by 1 plus the R, which is 3%. Take it over 40 to 365 days, and we end up with 398.71. And that reflects the opportunity cost of delaying exercise associated with European options. Okay, so those are calls. That's a brief introduction to the calls. Let me do puts now. The put lower bound is going to be this. And it's x minus ft. So basically, we're just substituting, this looks very similar to what we did before. We're just putting the futures price in instead of the underlying stock price like we did in chapters 3, 4, 5, and 6. Okay, so that looks straightforward. This is an American, so you can exercise it at any time. There's no discounting associated with it. Now, when we do a European, as you know, there's going to be discounting. And it's going to look like this. X minus ft, 1 plus r to the t power. And there we have the discounting, a discounting of both the strike and the futures price here on there. And so I have an example in the notes. It says, again, suppose that it's July 7th, an investor holds one futures put on July corn, and that's 40 days from now when the contracts expire. So we're assuming that the futures contracts and the options expire at the same time. The strike price is $5.75. The current price for corn delivery, according to the current futures price, is $5.60. The option is in the money by 15 cents per bushel. So on a per unit basis, right? And this was done, I did all this on a per unit basis. Again, you'd multiply this by the futures contract size and you also do the same thing here. Multiply it by the futures. That's what the throws here. Multiply it by the futures contract size if you want to get it on a whole contract basis. So let's do it on a per unit basis for a second, and I'll multiply it out. So for PA, it's going to be the maximum of 0, or let's see, 575, which is the strike, minus the 560. Okay, so that's the 15 cents that it's in the money by. Multiply that by 5,000 bushels, and you get $750. Okay, in this example. Now, with the European, we have to discount everything back. So let's take the 750, divide it by 1.03 to the 40 over 365, and we end up with 747.57 as the lower bound on a European put, European options futures put. Okay. Now let's do very briefly, without getting into without doing all the calculations we had done earlier, let's do the binomial model, and I'll show you that you can employ the binomial option pricing model using the hedging ratio like we did frequently in chapter 4, but we can also just figure out the probabilities associated with an up or down movement and discount all the payoffs back to time 0 as a shorter way of doing the computations. You should get the exact same answer, and that's what I'm going to show you. And I'm not going to show you every step, but I'm going to help you through it. So basically, we have an example in the notes where it talks about a stock index is at 1,300. Okay. The risk-free rate is 2%, so let's start writing this down. The dividend yield on the index is 2% also. So as you recall, that'll offset, those two will offset each other essentially, as you'll see in a second. And let's do the futures contract formula using cash and carry. So remember, the cash and carry model said that the futures price will equal the spot times 1 plus R minus the dividend yield to the T power. And in this example, we're looking at a 1 year contract, so T equals 1 year, by the way. And so when we do this, we have an index that's at 1,300, 1 plus 2% minus 2% to the T power. Well, that means the futures price and the spot price are equal. And that sometimes happens. I mean, this basically happened. This situation happened for a number of years after the Great Recession, because what happened was interest rates were really low, and they were pretty much in line for a while with the dividend yield, which was 2% or less on the S&P 500. So the interest rates kind of lets things grow at the risk-free rate, but this thing is generating a yield, cash flow yield, that offsets that cost. And so the futures and the spots are about the same thing, same price. And that's, like I said, that's exactly what you saw when you looked at quotes on options and futures contracts on stock indexes at the time. So now let's continue with the example. 1 year puts and calls have a strike of of 1250. Okay? And I have a strike of 1250, and the standard deviation of the futures price is 1348, 13%. Okay, standard deviation of the futures price. Okay, so what we're going to do is we're going to model in a tree the futures price. What you don't want to do, and it can be very confusing if you try to do this, is what some people try to do is they try to model the ultimate underlying spot price, and then try to apply the cash and carry model to that. It is a nightmare to do it that way. It's tedious. What we're going to do, and what the literature does, is forget trying to model the actual underlying spot price. Let's just model the futures price. And the futures price will go up, it'll go down like we saw before. Okay? So a couple more things before we get there is let's figure out U and D and the probability of going up and down, and then we'll move into the tree. Okay? So the U is, remember, it's e to the 0.1348 square root of 1 over 2. We're going to have a 2, n equals 2 steps here, like we've been doing. And so that means the up movement will be 1.10. Okay, so that's nice and convenient. Then D is 1 over U, and that's going to be 0.9091. Okay, so the futures price can go up 10% or it can go down 1 over 10%, basically, here. And so the probability of going up, now this is where it gets interesting. Recall we did the probability of an up move way back in chapter 4, when we did the binomial. We said it was 1 plus R minus D over U minus D. Do you remember that story? And so that considered the opportunity cost of money associated with flipping into the stock itself. And so that opportunity cost now is that opportunity cost is gone, and for the up movement, because you're entering into a futures contract that doesn't require any cash outlay. So remember the story I had here with the timing. You don't require cash flow at the time. So really what the formula boils down to is 1.00 minus D over U minus D. And when we do that, when we plug these numbers in, we get a probability of up is 47.62%, and the probability of going down obviously is 1 minus the 47.62. Okay? That is the setup. Now let's build the tree. Here we have a recombining tree. The futures price now is 1300. We multiply that by the 1.10, the up move, we get 1430. We multiply that again, we get futures price, because that's what we're modeling here, the futures price, not the underlying, 1573. The call payoff will be 323, because we're going to subtract the 1250 strike. And for the put, it's out of the money at 0. Okay, there we got it. Maybe I should back this off a little bit. Yeah, there we go. Now, multiply this by 0.9091, and we get a futures price of 1181.82, and a futures price all the way down here, 107.438. This is, since it's recombining, at 1300 carries over. The payoff will be 50, 0, 0, and then it will be 175.62. This is all should be very familiar to you so far. The only little difference is I substituted the spot I put in place of it, the futures contract price. So, like I said a few minutes ago, you can set these two situations equal, calculate the hedge ratio, H, right? And then use H to figure out the value of the portfolio here, and basically the value of the call on the up move at this point. And then you can value the call down here, and then value the call at this point in time today. So let me show you just one step here. There's 3 steps in doing, more than 3 steps to get all the way through. I'm just going to show you the one step using the hedge ratio here. And this is what I'm going to do. I'm going to say, look, set the 1573 times H shares minus, because we're shorting the call. Remember when you do the binomial, you're trading off the call, a short call versus the long futures contract in this case, where we want to find the right number of shares. So it doesn't matter if we end up from this point, we don't care if we go up or we go down, because we'll have the same value at the end. Okay, so those are equal if we have the same H shares. And H, remember, is a hedge ratio, and that kind of gives you an indication of the probability of the option finishing in the money. Well, it's going to finish in the money for the call, no matter what happens, if it goes up or it goes down, or when we're at this point in time. So therefore, H equals 1, and if we develop a portfolio here with the 1430 with H shares, which H is 1, and then we subtract out the short call, and that's what we want to figure out. What is the value of this call at this point? And we need to consider the opportunity cost of money for this 6-month period. And so the interest rate's 2% for a year. It's 1% for the 6-month period. And so what I've done here is I've taken the opportunity cost associated with buying the call. There is definitely opportunity cost of buying the futures contract, the futures option. That call option costs money. You have to lay money out. And so the time value of money is reflected there. You see that? But it's not reflected against the this futures price here. Because remember, when you flip into the futures price, you don't have to pay. There's no opportunity cost of money. So when we did stock indexes before, we did this. We basically grew the whole portfolio. We're saying, look, this portfolio is risk-free. We're going to grow at the risk-free rate. Now what we're saying is, we're just growing this option value by the risk-free rate. Okay, that's, again, that quirkiness associated with the opportunity cost between an option that flips into a futures contract that doesn't require any cash outlay. And we're going to set this equal to, doesn't matter if we set it equal to the up or down move. Let's set it to the up move, 1573 times 1 minus 323. And we saw for the call, oops, this should be CU right here, CU, because that's what I'm working on, that guy right there. CU turns out to be 178.21. Okay, so this is 178.21. You can work the same way, calculate call down, and then figure out the call at time 0, which is ultimately what we want to do. Recall, it's ultimately what we want, because we want to know what is the value of the call today. We can come up with this number simply by discounting this call back at, computing the probability associated with it. So multiplying this by the 4762 and this by 1 minus 0.4762 and dividing it by 1%, we can come up with the 178.21. I'll show it to you. Take the 4762, probability of going up, times the 323, and take 1 minus the 4762, which is the probability of going down, times the 50, and discounting it all back at 1.01. Or you could say 1.02 to the 1/2 power, because we're looking at 1/2 step, and you'll come up with 178.21. You might have a little bit of rounding pennies here and there because we're doing a lot of calculations. You could do the same thing. So there I just valued, really showed you the mechanics of how to do it, and I'll let you do the other steps to come up with the value. So the ultimate value is C subscript 0 in this situation. is going to be, let's see, 96.25 approximately. And then I say approximately because there's rounding. So when you calculate all this, it's 96.25. And you would get, for the put, you would come up with a put today of 47.24 if you did the put. So follow the procedures that we did earlier, and you should be able to come up with that value. Let's confirm it now. Let's do the black model, which is basically the Black-Scholes model, Black-Scholes-Merton model adjusted for futures, the quirks of futures options. And let's actually calculate the value and compare it. So remember, this is a two-step process. We're probably going to be off a bit because it's not an infinite number of steps, which is what the black model is going to reflect. But it gives you a lot of intuition. We just saw a lot of intuition come out of that. So here's the call today for the black model. It looks very similar to what we did before. It looks very similar. Whoops, ignore that. It looks very similar. There you got ND of 1, ND of 2, and I'll show you how to calculate that given the quirks and the opportunity cost of money. But here we basically have, look, this takes the place of S. Right? In fact, this whole thing takes the place of S. So remember, S was the spot price, the spot stock price. And that was already a present value. So current stock price is a present value. This is just taking the present value of the futures contract, which is really, it's basically the cost to carry model on a continuously compounded basis. Okay, so, you know, it's basically this. It's saying the futures price is S times E to the R times T. And when you solve for S subscript 0, you get a negative sign on there. So this is the cost to carry model, and just rearranging it, you can see the similarities that we have relative to the regular options contracts. And then here's the present value of the strike. So that's still the same as what we've seen in previous option models. So this, by the way, remember what is this? This is the probability of the option finishing in the money, conditional on when where the futures price is relative to the strike. And then this is the unconditional probability of the option finishing in the money on risk neutral. Remember, risk neutral probabilities of the option finishing in the money. So you have to eventually pay X. Okay. Now, these are for, by the way, I wanted to make sure these are for European options. So when the option expires, the futures contract expires, and you're going to have to pay X. You see what I'm saying? And so what is that worth today? Because you're valuing the option today, you need to calculate the present value. Okay, so let's actually do that. I think your textbook takes this guy right out, takes this guy out. It says E to the minus R T of 0 T ND of 1 minus X ND of 2. So don't get flustered by that. They just take that discounting out for simplicity reasons. And I'll work with it. So the present value, or I should say, well, actually you can think of it this way. The present value of $1 discounted at R, which is 2% for 2 years, or one whole year, is going to be worth 98 cents. That's the discount factor, times the 1,300, times 0.64, and I'll show you how to calculate that in a minute. The strike is 1250 times 0.58845, and I'll show you how to calculate ND of 2 in a second. So that's what these guys are here. So D of 1 is the log of the futures divided by the strike. Same math that we saw so far with the regular Black-Scholes-Merton model. And normally we have an R here. Remember we used to have, I'll put it in, R plus sigma squared over 2 times T here. The R is gone because the opportunity cost of money. This, in other words, the futures contract is not growing at rate R like the underlying stock price did. So the underlying stock price was growing at R when we did stock index options, but now with futures contracts it's not growing, so the R is not in there anymore. But the sigma squared, because we still have volatility in the futures price, and so this is going to be 0.1348 squared over 2 times 1 year contract divided by 0.1348 square root of 1. This comes out to be 0.3584, and if you look up the ND of 1 either in an Excel spreadsheet or a table that's given in the book, and then ND of 1 is 0.64, and ND of 2 is the 0.3584 minus 0.1348 square root of 1. That equals where did I put 0.2263, and 0.2263 means that, you know, recall you got this normal distribution set at 0. So if we're at 0.2263, we have to be 50% plus a little bit more here, and it turns out to be 0.58845. 58, almost 59% is the cumulative area here under here. And that matches up with that number. So when we do the calculations and we're all said and done here, let me try to get it on the same piece of paper. The call today is worth 94.55, right? That's what I calculated by hand. When I did this in the software that comes with the text, I got 94.48, and that's, you know, rounding. You know, look at all these calculations I do. Sure going to lose something in rounding, and I did. Only a couple of cents, and also compare that to the 96.25 with the two-step binomial. So technically, these numbers are probably the best numbers to compare. The difference between the two-step versus an infinite number of steps is this, you know, just under $2 difference here. So we're a pretty good approximation. We got the concepts worked out there, which is the important part. If you figure out the price of a put, now the price of a put here using the black model, the formula is this. Okay, can you see that? Yep, got it all on the video. And so that's 1250 times 0.9804, 1 minus 0.5, this be 2, make sure that's a 2 there, 0.58845, the same ND of 2 from the call, the same ND of 1 from the call, there should be a 1, minus the 1300 times 0.9804 times 1 minus 0.64. So remember, this is the 2 and this is the 1. That's easy to confuse there. And when we get done, we come up with 504.35 minus 558, 80, 83, and that's 45.52 according to my hand calculation. According to the software, I got 45.47. Okay, 45.47, and that's 5 cents due to all my rounding in these calculations, assuming the software is 100% correct, and I think it's pretty good. There. So by the way, how did I do this? How did I do this in the software? Well, you're going to put in, for S, you're going to put in the futures price. And you're going to put in 1,300. You're going to put in a strike of 1,250. Now here's the trick. You're going to put R in at 2%, but you're going to put the dividend yield at 2% also, and they tend to offset. Not 100% through the math, because there's still some discounting. Notice there's still some discounting going on here, but you don't see the discounting in some parts of the math, like in the calculation of ND1, even though it's showing up here. So what happens is when you trick the software that comes with the text by putting R of 2% and a dividend yield of 2%, it tricks it into calculating the price the proper way. It handles it through the math. The math underlying it handles it this way. You just can't net R to 0 and the dividend yield to 0. You won't get the right price because it's picking up R and it's picking up the dividend yield in different places. So you need to put both in. And then we have T of 1 year, and we have sigma of 0.31348, and then you have all your inputs that you're going to need, and out will pop up. For example, the put will come up to be 45.47. Okay. Now, let's make sure we have a handle on what's going on here by looking at futures options put call parity. Okay. So futures options put call parity. We're going to set up 2 portfolios for this. Just, this is going to be reminiscent of what we did back in Chapter 3 when we derived standard put-call parity, or what's sometimes called spot put-call parity. But nobody really calls it spot put-call parity unless they're trying to compare it or they're in the same context as futures options put-call parity. So keep that in mind. There is put-call parity, various put-call parities, and there's others out there besides what we're going to cover. But let's put let's build a table and see what we can work out for this parity condition. So we're going to have 2 portfolios, and let me just spell out we're going to have portfolio A and we're going to have portfolio B, and portfolio A is going to be long a futures, and we're going to be long a put. And for portfolio B, we're going to be long a call, and then we're going to be long a bond. And the bond is designed to have a payoff equal to the difference between the strike and the futures price, which is reminiscent of a payoff to a put. Okay, so let's build a table on that. And we're going to look at the current value of these portfolios in each one of these instruments and the payoffs at expiration and see what we can deduce from it. So, portfolio A, we're going to have the position. We're going to have current value. And then we're going to have payoffs at expiration, and that's when the futures price is below the strike or at the strike, or the futures price at expiration is above the strike. And so we're long a futures, and the current value of a futures contract that we start out, remember current value is 0, so we're applying that idea here. Current value is 0. And it doesn't matter whether or not you're above or below the strike for the futures contract. Okay, so the futures contract is simply the payoff is going to be the difference between the futures price you locked in at time 0 and the futures price at expiration, which is technically the spot price also. Remember convergence theory. And so it doesn't matter. And so in each situation, this is equal to this because a futures contract does not depend on strikes. Now the long put will depend on where we are relative to the strike. And so here we'll just call this PE for simple because we're dealing with, by the way, European puts. So remember we did put call parity. We're looking at European options. So here's a European put. In a second we'll do the European call. And for the European put, the payoff is, well, it's X, the strike, minus the futures price at expiration. If it's in the money, which is what happens when we're here below the strike, at or in the money. And then 0 otherwise. Okay, and then so there is this portfolio A. Now if you add this up, notice what happens is this cancels out, and you come up with X minus. Let's see. Oops. Let's see. X minus 0t. And then here we have ft minus f0t. So all I'm doing is writing this down here, and I'm netting this off. And so here's the payoffs at expiration associated with portfolio A. Now portfolio B has a long call. Call it CE for the call for European. And that will have a payoff of 0 when it's out of the money, and if it's in the money, it'll be the difference between the futures price and the strike. Okay, so this is the long call, and then the long bond, which is probably the least intuitive. So you really have to be familiar with this work, but what we want to do here ultimately, and I'll show you here, is we want this bond to mature for this difference. Now you would never think of that. You'd actually have to force the math if you were unfamiliar with this idea, but people have been working with this for a while, and they know what the math ought to be, and they know it needs to mature for this amount, as I'll show you in a second why that is. But notice the bond doesn't matter if it's above or below the strike because the bond matures for this amount regardless. Okay. And so the present value of this bond is nothing but the same amount divided by R1 plus R to the T power. Okay. Now this portfolio, what does portfolio B look like cumulatively? Well, it's X minus FT, right? And then it's, notice what happens, the X's cancel here, and we're FT minus F0t. And what you notice right off the bat is, look, we got portfolio A, portfolio B, we looked at the payoffs at expiration, and notice this is equal to this. The payoffs for A and B are equal when the futures price is below the strike, and they're equal when the futures price is above the strike. So these two portfolios are equal in value. And if these two portfolios are equal in value at expiration, when it pays off, then these prices should be equal today, assuming no arbitrage situation. So if you really, what we need to set these two equal. And so ultimately what it looks like is we take the 0, we plus C, we minus P. And the reason why I'm doing this, I'm just rearranging these numbers here. So it looks like put call parity that we're used to. And I put the 0 in just to show you it's dragging down. And it's going to ultimately look like, this, X minus F0t over 1 plus R to the T. But when you put a minus sign here, ultimately what it looks like is F0t minus X divided by 1 plus RT, just distributing that negative sign. And so ultimately what we get is C minus P equals F0t minus X over 1 plus RT. See, what you're seeing here now is, look, this is what we've been talking about so far in this video, is that we're discounting not only the strike, but in this case we're also discounting the futures price back, because we have to discount that futures price back to what is it worth today. When we had put call parity for a regular stock, it looked like this. We only discounted back X because the stock price was already a present value of the future dividends of the cash in the cash flow of the stock. So it was already in present value form. So all we're doing is we're just making a slight adjustment for that, like I keep saying, that quirk associated with timing, and what we're discounting and what we're not discounting. So if you were to compare this, we would have, did the math we worked out earlier with the black model? With the black model, we had a call for 45.47, and we had a put for 45. We had a call for 94.48, and we had a call for a put for 45.47. And by the way, I just noticed I had a mistake. I'll have to fix the video. This is 45.47. The put according to the black model and the software, computed from the software. So 45.47. So the difference here will be $49.01, and that difference will equal the futures price minus the strike, discounted back at 1 plus R to the T, and that equals 1,300 minus the 1,250, so it's $50, discounted at 2% for the year, and that's 49.01 or 02, slight rounding differences. So it matches up. So there we have it. Put call parity ties out for futures options. Futures options put call parity, the derivation, and then the check that the model works. Now, one more thing before we're done with the video, and that's early exercise of futures options. And obviously, if we're dealing with and discussing early exercise, we're looking at American futures options. And so if you recall, when we did standard stock options, and we asked, is it ever optimal to exercise a call option on a non-dividend paying stock early? Is it ever optimal to exercise? And we figured out that it's like, no, it doesn't make sense to do that. It doesn't make sense. And so you would never exercise it. If you wanted to get the stock, what you ought to do is sell the option, collect the pure time value, collect the speculative insurance value, and then get those extra proceeds and buy the stock in the open market. You're better off doing it that way than exercising the option. But with options futures contracts, it's different, because when you exercise an options futures contract, you're entering into a futures contract. You don't actually buy the futures contract. There's no money or cost associated with it. So the opportunity cost is not there. And so it may be optimal to exercise option futures contracts, especially if you have an option contract that's in the money, because if it's in the money, your broker is going to credit your account by the amount that it's in the money by. And that money will go into your account and earn a rate of interest. So the bottom line is, it may very well be optimal to exercise futures options on calls early. And that's the point I wanted to make here, and that's all I wanted to say about that.